For the last century, workers have mostly invested in stocks and bonds in their retirement accounts. If they invested at all, a lot of people just had pension plans. But today, workers are increasingly investing in alternative assets, including in their retirement accounts. So today, we are bringing in Henry Yoshida. He's a certified financial planner. He is the founder and CEO of Rocket Dollar, which is an IRA custodian company, to talk about alternative investments and whether they make any sense at all to put in your retirement accounts. So, Henry, welcome to the show, and I'm excited to dig into this with you.
Yeah, thank you very much. It's still a controversial topic when I get asked about this. It was even more so when I started the company in 2018. But I've thought about this a lot, and I've worked with these retirement accounts since the beginning of this century. And it just makes a lot of sense to me. This episode and my platform isn't to tell people that they should invest in alternative and private investments, but if they do, I make a very good case for saying why that should be held and inside of a tax advantaged retirement type of account and so forth. So that's kind of what we're here to talk about today, and sort of give the reasonings from my perspective as someone who works with these accounts day in, day out. We have tens of thousands of customers with over $10 billion, $12 billion in assets now. So pretty good position to see what people do with these types of accounts and why they should hold them there as opposed to just outside in a normal taxable account.
Well, let me ask you. So I was going to ask you a different question, but there's a question that I'm going to put you in the hot seat for a second here. So,
all right,
say that someone like me plans to own both stocks and real estate. Real estate comes with a lot of baked-in tax advantages. Stocks really don't. So, if I'm going to own both, in my philosophy, it has historically been, well, I'm just going to put stocks in my IRA since that's just easier. I don't have to go out and set up a self-directed IRA for that. And then I'll hold real estate just taxably, right, in my personal name, my passive real estate investments. So make the case to me that I'm thinking about that wrong. So why should people like me put some of my passive real estate holdings or active, direct holdings in a self-directed IRA rather than just going to like Charles Schwab and putting a bunch of stocks in my IRA?
Well, if you are doing real estate, though, it may come a point. So there's contextual reasons why you may or may not hold that particular real estate inside of an IRA. One might be that in your case, you're someone who owns passive real estate. You're taking advantages from a tax standpoint with your tax advisor, what you can do. So depreciation, you can deduct those expenses and so forth. But let's just say that you've done this now for your first, second, and maybe even third property. Like for a lot of people that we work with, that first and second, and maybe even that third, they're what they call the accidental landlord, right? Like it's just a house that they actually bought to live in, and then they decided not to sell it. And that turned out to be a good decision because most real estate in most major markets, top 75 markets in the US, have appreciated pretty significantly if you've had a hold period of over 15 or 20 years. Pretty similar to stocks. But by the time you get to the fourth, maybe your limitation in your context actually at that point is a limitation of capital. And you don't need that income stream from in the form of rent. So you are able to access at this point your mid-career. So you said to use yourself as an example. So
I am mid-career,
mid-career. So you've had other jobs. You've accumulated money in 401ks, and you've since rolled those into IRAs of your own at Schwab, at the example that you used. But in that particular case, you invested in stocks and they appreciated. So now you're in a position where you have appreciated stock inside of this IRA account, and you want to purchase another real estate property. You just don't want to do any capital that's outside of this IRA to use it. So maybe you decide to open up a Rocket Dollar account, take $200,000 and go purchase a whole new property. Now, this property is going to be different from the three that you own in the word you use, taxably. I'm not sure that's a word, but that's probably a good one to coin. I like it. And now, instead of working with your advisor for depreciation, calculating all the expenses, keeping track of your spreadsheet, and then determining how this rental income will now get added to the other income that you earn, this particular house now just is a owned property inside the IRA. It's owned by the IRA. Any income that comes in the form of rent is not that dissimilar from a dividend that you might receive on a stock inside of your IRA. And if that house appreciates over time, you're able to sell that and only pay money on the amount you distribute. So it's just treated for that purpose. So I'm not saying it's better or worse. It's just different is what I tell people. What I would say is that, in most investments in the private space, dollar for dollar, If you just own it inside of an IRA, you'll actually make a better net return because the tax treatment is more favorable than owning it outside. And this is the reason why. Private investments are largely held by institutions, smart institutional type investors right now, endowments, pensions, high net worth individuals, and private equity funds. Most of those actually have two things that actually the closest relative to that for an individual investor are long time horizon and great tax treatment. So those are endowments and pensions. So, and they own typically 50% or more of all of their investment holdings inside the private and alternative world. So the closest thing that a retail investor has to that, matching long time horizon and great tax treatment, is pretty much their IRA and 401k type of account. So if you are going to do alternatives and diversify your personal investment portfolio, you should do it there before you decide to do it in a taxably account. Real estate may be the exception.
All right. And then, I'll add one other argument on your behalf there that a lot of the stuff, a lot of the passive investments that we make, that we vet together in our co-investing club every month, a lot of these are income oriented investments and that income gets taxed at your regular income rate. So, private notes paying interest income or, funds paying distribution income. And those are great things to put in an IRA so that you're not being taxed on that income as part of your regular income stream.
Right.
And a lot of
Unless
our
you need
members,
that income, right? I mean, some people in your co-investing club, this may be a source for them to create a regular income stream to live off of. So that'd be different. They need access to that money. But if you don't,
people are being
then
put
the
on,
reinvested income, the way I always tell people is that you look at an investment with a 10% return. If you decide to invest in that directly using taxable money, right, your real return is actually 10% divided by your tax, one minus your tax rate. Okay. So
right.
you end up with something less than that. Let's just say it's 7%. But if you own it inside of an IRA, then you actually go the opposite route because, you're actually making greater than an absolute 10% return. You may make like, 11, 12, 13, depending on that tax rate, especially if you reinvest that money. So again, the argument for holding a private investment inside of an IRA or not is usually contextually and personally driven. So it depends on the circumstances and the context of the situation. And what I tell people is that our platform is just there to give people that flexibility to choose to do so outside or inside. Maybe you purchase one or every other real estate property, for example, inside and outside, because you do get great tax advantages by owning it directly and you can depreciate that property and write off all the expenses. But in another case, like, this one kicks off a lot of income that you may not need. You don't do the depreciation, but you're able to reinvest that cash once it accumulates to a large enough amount and go into a different deal.
Yeah, and a lot of our members actually do that. They'll alternate, or they'll invest in some of their investments under their personal name, and then they'll put others in their self-directed IRA or their solo 401k for the tax advantages from that. So, before we hit the record button, you made an interesting comment that I would love to just dig into a little bit deeper. So, you told me that alternative investments will surpass public investment holdings by retail investors by the year 2035, so less than 10 years from now. So I'm curious to just hear, the data that you have to back that up, and why, what's the argument behind that case?
Right. Well, I just think that the availability or the supply, the sheer supply of private investments is growing, all the time right now. And there's two reasons for that. One is that private companies, private investors, private issuers, they're able to accumulate capital without having to register and go public. In other words, there was a time for many times in modern American investment history, the only way that you were able to attract capital was to publicly register your shares and then make that known to the broader public. Now, whether that was an individual or whether that was an institution who was going to buy it for their mutual fund or their brokerage firm and so forth. But now it could be argued that since companies are having the option and they have access to private capital without going public, they'll continue to go that route because there's just less cost to do so. There's more ability to get capital. So case in point, we were talking about this off camera, but the largest well-known private tech companies today, they have an ultimate goal to go public. In other words, eventually they'll go public because that's the way they'll provide liquidity to their somewhat closed group of shareholders. Let's say in OpenAI's case, that would be Microsoft would be a gigantic winner. SoftBank would be another gigantic winner if they were to go public, right? And where's that money going to go to give them that liquidity? That's when they sell the shares to us as public investors. But that's the end game. You go backwards like 20, 25 years, in 30, 40 years, that was the beginning game. The beginning game was to get a company started, go public, and then grow with capital that you received from being a publicly traded company. We talked about Amazon. I mean, we're using numbers here that for 100 years people have invested in stocks, bonds. Well, 401ks are roughly 51 years old, 51 and a half years old. They were started in 1974. Amazon is getting close to being 30 years old, so almost getting to the point where they're starting to adult here a little bit. But when they went public, they were doing in the $30 to $40 million in annual top line revenue range at that point. So a lot of their growth was capital given to them by people buying their publicly listed shares. Now, in 2035 and between now and then, that's going to change. More accessibility, more ability to go into these types of companies. You won't have the need to go public to get capital to grow your business. And the last bastion of that will be to tap into the retail investor money, which they're trying to do now. There have been laws, executive orders recently signed to start putting private equity investments inside of 401k plans. Once that happens, if it's less cost and the same ability to get the same distribution, then they're going to go with the less cost structure, and it's going to become a bigger and bigger part of the retail investor's portfolio. And private doesn't mean that you know nothing about it and it's completely risky. We used real estate as an example. I mean, it could be argued that a single family home in Owings Mills, Maryland, for someone who lives in the Baltimore area is a lot more tangible today than let's say one share of digitally recorded stock in a company of any publicly traded stock.
Yeah, I mean, and that's something that we have already seen play out over the last 15 years with just more access to both private equity investments and real estate investments, passive real estate investments to retail investors. So, the Reg CF regulations, the crowdfunding regulations, I think that was just 2011. I mean, you probably know better than I do, but it was pretty recent when that became available to the public. Now, I used to be somewhat of a fan of real estate crowdfunding platforms. I don't think that they performed well in more adverse market conditions over the last few years.
Sure.
They spend a disproportionate amount of their time and money and energy on polished marketing and less on actually operating properties well. But they're not the only way that it's gotten more accessible for retail investors to get into these kinds of private holdings. I mean, investment clubs like ours, our core investing club, makes it easier for people to invest with small amounts in private equity real estate or other passive real estate investments. So I buy the Kool-Aid. I'm drinking it. That it will. We're seeing alternative investments in private holdings growing at a disproportionate pace among retail investors. Now, I do want to be a little conscientious of time here, but you brought up an interesting point before we hit record that I would just love to hear your take on. You were talking about how politicians love Roth IRAs, and I would love to hear your reasoning behind why that is. Because I myself am a big fan of Roth IRAs. So yeah, so why do you believe that politicians love Roth IRAs?
Well, I mean, politicians live basically between now and the next election. So,
Right.
I mean, the concern of a politician today is what makes them look good and what helps them right now for the rest of their term, whether that's 1 year, 2 year, 4 years, and 6, depending on, what particular office you hold. So, I don't know if a lot of people know this, but the Roth itself is actually named after a late senator, Senator Roth from the state of Delaware. And the reason why they like it is that they're okay if someone is willing to pay the taxes up front to put money into a Roth account. We love it, you love it, because you put money into a Roth, you pay taxes on a smaller amount today, you invest that money wisely, it grows hopefully to a much larger amount over time, at which point you never pay any taxes. But remember, that point in time down the road is 10, 20, 30, 40 years, well beyond the term of any current politician. So they're happy to get the revenue today because that's what they need today. They want that revenue today. So the politician cares about the immediate revenue. They're not worried about this issue 30 years down the road. I mean, I used to joke around and say that, that'll be a problem to be dealt with by, another Bush or another Clinton, like these families that have sort of had, generational people inside of the White House, like it'll become like, Chelsea Clinton's granddaughter's problem. When that person becomes president in the year 2062 or something like that, to have to make up the tax shortfall. But what President Donald Trump cares about today is maybe getting as much revenue as they can. And it's a great trade-off, right? I mean, the reason why you love it is that you pay taxes today on the small amount of money and never pay again later. So it's a win-win for your side and it's a win-win for the politician side. And I think that's why they love it.
Yeah, I mean, they're playing the short game, to your point, and you and I are playing the long game of minimizing our lifetime taxes, and
Right.
letting our investments compound tax free, and pay no taxes in retirement, which means we need a much smaller nest egg than we would if we had to pay taxes on those withdrawals. So, anyway, that's great. All right, so Henry, in 30 seconds or less, how do you help people, and how can people connect with you if they want to take you up on that help?
So with us, there's a wealth of information at our website, rocketdollar.com. So we have a very well-developed knowledge base section that actually answers a lot of questions about alternative investments and how these IRA accounts work. So that's one way to reach us on the website. For me personally, you could find me. I'm pretty active on Instagram and LinkedIn. So it's just, you can look up Henry Yoshida and you'll find me there. But those are the best ways to find us. And then the best part about the website is we have a number too. So you can actually call our phone number and ask these questions that you might have and riff about
I talk to a
private
person,
investments and
an
how they work.
actual person.
Yeah, and talk to a person. So it's not AI, it is a person. And we answer questions and we are on the phones all day long, Monday through Friday.
And we were talking earlier about, I asked you a little bit tongue in cheek, why should someone not invest in Schwab and invest in this other way? But good luck getting someone on the phone at Schwab. I mean, you can do it if you're willing to wait in their phone tree for a half hour. But
Yeah,
I love that when you work with a smaller firm or a more intermediate sized firm like yours, you can actually talk to a person and pretty quickly, which is you're
exactly.
not going to get from those mammoth corporate behemoths, right?
Right.
So I love
And
that.
I do think you should invest in everything. I mean, people usually transition to investing in privates after they've made and had success in the public market. So they do all work together. It's just that right now, public markets are concentrated. They've been going up for a very long time. And it's one thing when you have a $10,000 portfolio, losing 10% is $1,000. But when you have $1 million portfolio, 10% loss is $100,000. So, at that point, you need to start thinking about managing the risk, diversifying the portfolio. One of the ways to do that might be to consider opening a different type of IRA account to purchase an investment, through a co-investment club into a real estate deal.
Yeah, absolutely. And I'll tie up with one final stat. Um, you talked about diversification. So the S&P 500, and this is a little bit outdated. The last time I checked these numbers was probably 6 months ago, or maybe even a year ago. But the top 10 companies in the S&P 500 made up the same weighting in it as the bottom 450 companies. Just to your point of how top heavy the S&P 500 is, and other stock indexes, they are very
Exactly.
top heavy. And that is, by the way, at least when I was looking at that, again, it's probably 6 months out of date, but I'm sure that still applies, maybe even more so today. That was the highest weighting it had ever been for the top 10 companies. And that just seems to be getting worse, with these tech giants. And, if one of them falls, first of all, the others will probably fall because of all the circular dealing that they do.
Hmm.
But, that could crater your investment account.
Exactly.
But retail investors, we think, oh, I bought an index fund with S&P 500, 500 companies. I'm very diversified. Well, not really if, 40% of it is made up for the top 10 companies. So anyway,
Yeah.
on that note, guys, if you got a fresh perspective from this episode, subscribe to the show and pay it forward. Pass it along to friends and family members, neighbors, colleagues. And if you didn't get anything out of the show, then, shoot us an email, support@sparkfinancial.com. Let us know what you want to hear more of, less of, whatever. And finally, consider joining us in the Co-Investing Club. We get together every month, sometimes twice a month. We vet passive real estate investments and we go in on them together. So each person can invest small amounts. And if you're not familiar with passive real estate investments and how they work, we've got a free course on it, sparkfinancial.com/free. So on that note, stay weird, unconventional investor. We'll catch you next time.